He sure made me sound very smart, but anyway, I've had a great career in the oil business, and hopefully going to demonstrate a little bit what I've learned through my years of experience in working with the crude marketplaces. So I guess first and foremost, I can remember being an 8-year-old young man going with my mom to a gas station here on Texas Avenue, and during that point in time, we'd go into the service station. They had a thing called gas wars going on. Gas wars basically were they were trying to sell gasoline as cheap as they possibly could, and to entice you to come in, they would often give away free things such as stemware and glassware and so forth. Well, if you fast forward just a couple years, you're going to see how the dynamics change very, very quickly. Pardon us just 1 second. There you go. You do it? Okay. All right. Again, describing 71, how we had gas wars. All of a sudden, you fast forward to 1973, 1974, and we learn about OPEC and the power that they had over the United States. This is why I call it game changer. OPEC came in, they cut back, they rationed oil to the United States, and it raised prices dramatically, and it had a dramatic impact on us and the way we manage our business. Out of this, there came such things as the Japanese auto industry developed into superpower. Their smaller, more fuel-efficient cars became something that Americans turned toward. We saw where, basically the United States developed another energy, mindset. We moved into things such as natural gas, nuclear. We started to move away from petroleum in a big way. And so you're going to see that as we go through the slides today. I titled this slide, The Key Hysterical Oil Events. And if you really look at this, what you find, it's not working now. Is this the other one? All right, here we go. If you look at this chart, what you find from the beginning of the oil industry, the inception 1861 through about 1920 or 30, this is what I call a boom and bust cycle of the oil marketplaces. And you find where there's a lot of peaks and valleys as production came online, demand ramped up, and prices came back in check and so forth. So we see a very strong boom and bust cycle. And that continues on until we get into about the 1930s to about the 1970s. And the 1970s is where we talk about what happened with OPEC, and we go through some Middle Eastern conflicts, obviously in 1991. Then we see the Far East impact on basically driving up the price of oil. What happened, though, is in the 1930s to the 1970s, a unique event occurred. It was called the East Texas oil fields. And what happened was the East Texas oil fields came into power, came into production at that point in time. And what happened was the major oil companies of the day, the Seven Sisters, they used those oil fields to basically regulate prices. And so we see the biggest stability in pricing during this time frame. And that was good to run a business, a good to run a business model. And we see where that led to growth. And as oil fields came on in the Middle East and as oil fields came on in Indonesia, they'd back down production. So basically, East Texas oil fields were the Saudi Arabia of their day before Saudi Arabia's time. The key players, and this is even true of today, the key players are really the Seven Sisters versus the nationalized oil companies. And think of that if you put it in today's perspective. Basically, you're looking at the Seven Sisters would be technology and expertise. That's what we're seeing today when you look at the shale plays versus the nationalized oil companies, which is the abundance of reserves. They can overwhelm marketplaces with their power and ability to move markets by putting more oil in the marketplace. All right, the Seven Sisters, to give you a brief snapshot on those guys. 1908 through 1950, they held power and sway over the world markets. They dominated those oil markets. It was comprised of Exxon, Shell, BP, Gulf, Texaco, Mobil, and Chevron. 52 through 1978, as the Middle Eastern oil fields came on, we saw 300 companies get involved, and we end up with 50 state-owned oil companies. Today, only about 10% of our reserves are with non-nationalized oil companies, so it's very slim pickings to say the least. If you look at oil production down at the very bottom, 1973, the major oil companies had 25.5 million barrels a day of production. They were over 50% of the marketplace. You fast forward to 2013, and they're now, about a little bit less than 13 million barrels a day, right around 15% of the marketplace. So they've lost tremendous market power, and it's all turned toward the nationalized oil companies. Nationalization, really 10 countries nationalized prior to 1970. I guess a key one here is Mexico just recently signed, it was last month, they signed that they're going to go back away from nationalized oil and back to free enterprise and free trade. So they understand that the ramifications of being nationalized, you lose out on production capabilities, and so they're turning back to the open marketplace to try to expand their reserve capabilities. And so we're seeing all this today in the pricing, and I'll show you some slides coming up where we're seeing this technology kind of overwhelming the pricing and leading to a little bit lower prices, and I think it does have some sustainability. Here's where power is. If you really look at power, if you look at this chart, it basically shows where the reserves are. If you look on the reserves, it's Venezuela and Saudi Arabia. Canada is obviously open for free trade, as well as Russia to some degree in the United States. So basically, of the top 20 reserves in the world, only 3 of them are open for production by, let's say, the oil majors and their counterparts today. So it's pretty small playing field. That's why I think you look at what's going on in East Texas, what's going on in Central Texas, what's going on in the Panhandle region of Texas, and what's going on in North Dakota with the shale plays. These guys have nowhere else to go. They've got to go to these shale plays to get production capabilities. As far as the world oil demand versus the percent spent on GDP, I'll give you a little indicator. When oil is about 2% of GDP, we end up with pretty stable growth on your consumption. That's the consumption line here, and this is your percent spent on GDP. 2% is a pretty good level. Anytime you get above 3%, you get into what I call the red or the yellow zone, and when you get above 4%, it's definitely a red and so forth. And what you find is if you get up 4% or higher, you're going to find an impact on I guess the prices end up coming down. There's been 11 recessions in the U.S. 10 of them are due to oil price shocks, and so very much if you follow this GDP line, you'll find out we get above this level. Now it's interesting. You fast forward over to 2010, 2013, 2014. We're at that 4% level. We're in definitely the yellow and red zone. And what's happened just recently here, we're seeing basically additional production come onto the marketplace. Prices are coming down because it's just too expensive. I'm not going to spend a lot of time on this graph other than to say if you really look, the top line is consumption in barrels per day. The red line is GDP, and they obviously mirror each other pretty closely. So basically the world grows using petroleum to grow and expand its GDP base. All right, yearly domestic production of crude oil. If you look on this chart, we pretty much peaked out in 1970. I guess when I had the good fortune of buying 19-cent gasoline with my mom at the service station. And then we pretty much fell off. And then we fell all the way off until about 2008. We got down to about 5 million barrels a day. So we peaked at 10 million, fell down to 5. Today we're at 8.6 million barrels a day of production. And if you look at it, the projections going into 2020 or so, we should be somewhere about 10 to 11 million. That puts us back on par with Saudi Arabia because their production levels are right around 10 to 11 million barrels a day. If you look at where the U.S. growth has been, it's been largely driven by what's happened in Texas. And so Texas has gone from a little over 1 million barrels a day, and this is a pretty steep peak. And what we're finding is they're adding about 2 million barrels a day of production capabilities in the Texas marketplace. Most of that, as we know, is the Permian Basin and the Eagle Ford Shale production capabilities. What's interesting to note is between Texas, and I would have bet you 10, 15, 20 years ago being in the oil business, if you'd have told me North Dakota and Texas would have 50% of the production capabilities in the U.S., I would have bet you any kind of lobster dinner or steak dinner anywhere in the world. It just wasn't thinkable back in those days. That just tells you how quickly technology can impact what we're trying to do as an industry. All right, as far as the crude plays, the shale production plays largely reside on or near existing conventional oil plays, and that's what this chart's basically showing. And so it shows where these shale plays are. The Eagle Ford Shales in this area. We've got the Permian Basins over here. Obviously, we've got the North Dakota Bakken up here in this region. And so these are changing the marketplaces, and it's changing the way industry is being run. And we'll see some impacts of that in some further slides. I put this up here just to basically mimic. I wish I could overlay the two together because really if you look at where those conventional crude plays were and where refineries were developed, they're basically on top of each other. That was a traditional way that the market worked, where these crude fields were developed and produced that turned into a refinery structure. We'll spend a second here talking about Texas. It gives us something to be proud of about the state. Texas has 4.7 million barrels a day of production capabilities. 25% of the refining capacity is in Texas, all right? Texas, again, with 3 million barrels of production of crude oil a day, that puts it in the top 8 in the world as far as crude producers, all right? The forecast for Texas is to go to about 4 million barrels a day. That would put it in the top 5 of crude producers worldwide. So Texas, our little state, is mighty and big in the worldwide marketplace. Also, if you look at Texas, our GDP is 1.4 trillion a year. That places number 14th in the world, right behind South Korea. So Texas is definitely an economic force in the marketplace. The question I get asked all the time is the shale plays, are they sustainable? And the answer is, I think, probably yes. And the reason I say probably, because if you look at economics do drive, this is very expensive material to get to the marketplace. A conventional oil field is about $10 to $25 to get it to a commercial development cycle, okay? If you look at a shale play, it's pretty much $45 to about $65 a barrel. So if crude prices fall, you certainly impact the ability to get it to the marketplace on an economic situation. So one thing I will say, if you look at this chart, assuming crude stays at probably $75 a barrel or higher, we believe that the shale plays will last at least 20 to 25 years. I'll make 2 other points on this slide and then we'll kind of move on. The first one is Saudi Arabia is now coming out and realizing that they're losing out in the worldwide marketplace. And so they've been making some announcements just the last couple of days saying that they're going to go into trying to maintain market share. If that's going to be the case, then what they're going to end up finding is they're going to be putting out more oil in the world marketplace. So OPEC's in disarray. You have the Iraqs, you have the Irans, and you have some of the other ones that really want to have high prices. You have Saudi Arabia wants to maintain market share. So we've got a little bit of dichotomy even within the OPEC nations on how to manage it. As far as looking forward for us, one other thing to mention, if I wanted to maintain 1 million barrels a day of production capabilities, if I was to drill in a shale play, it would take 2,600 wells to maintain 1 million barrels of production 5 to 10 years out. If I was to drill for the same 1 million barrels of oil in Iraq, it would take 60 oil wells. So you can see the technology, expertise that's required to maintain 1 million barrels a day on a shale versus a conventional play. All right, this really gets into the heart of the matter where we are today. This is open interest. This is the fund's ability to kind of buy and hold contracts. The funds meaning the commodity trade community. And what's happened is this graph goes from 2010. It's not as clear as I'd like it to be, but it's 2010 through today. And what you'll find is on this top graph, this is open interest. These guys have strong ability. When China was growing robustly, what you found is that they thought we were in the peak oil scenario. It was kind of the commodity super cycle, I've kind of phrased it. And what that meant is basically there was a limited amount of resources, and those resources meant prices were driven up because there was a potential scarcity of supply. The commodity trades got in that. Now what's happened, the commodity marketplace is realizing with these shale plays, there's an abundance of crude and there's an abundance of reserves out there. So prices are being reflected, and we'll see that on the next slide of what's happening. This is really from June of this year through October, just a few days ago. We saw where basically ISIS, when they had their impact in the Middle East and they started doing some pretty bad things to some folks, our journalists and some other folks, it created a scare in the marketplace. That drove up oil prices. That's what happened back in June and July. Since then, as we've had shale plays coming on to the marketplace and adding as much as 100,000 almost barrels a month, we're seeing prices slowly start easing down to where we are today, about $85. If you really look at shale plays, I think realistically most people think between $70 and $75 a barrel. As long as we maintain ourselves above that, these shale plays will be somewhat economical as new technology comes into the marketplace. So where do I see oil prices? I don't know if I see them going back up above 100 in the short term unless geopolitical events really get outside of our control. Let's say like Iran ends up with a nuclear weapon and threatens the worldwide marketplace. So I think we're in a fairly stable, I guess, oil price, maybe even a slight decline from here. One of the things I always look at too is OPEC's ability to have excess capacity, because it's certainly, if you look over here on this far left-hand side, you'll see the gray areas is their spare capacity. And anytime spare capacity gets below 4 million, that's when prices start to rally. When it gets below 2 million, I guarantee you're going to see a price shock, and that's going to happen. It's happened every single time. What you're finding, though, is we get into kind of 2013, 2014, we're above that 2 million barrels a day of a spare capacity drawdown, and we're above that. That says to me we should have stable prices in the interim. We shouldn't have any dramatic price shocks other than geopolitical events. As far as OPEC's call on global market share going forward, I think they're going to be somewhere in this 40% range for the next 20, 30 years. So I guess there's just a worldwide adjustment made. Generally, we look at about 1 million barrels a day are added for excess or increased demand every year. But unfortunately, with some of the slowdowns in some of the economies, that's been revised down to 650,000 just in the last few days. I've seen that adjustment in the marketplace. Again, that's kind of helping keep the prices depressed in the short term. All right, if you look at our domestic crude options, if you really look at it, you say Permian Basin back several months ago was being discounted $20 a barrel to move it. And there's a reason, because refineries really weren't structured to run this light of a crude. And so refineries end up having to reconfigure themselves and spend a lot of money. It takes about 2 to 4 years to change a refinery structure over to handle a different crude slate. And it takes generally about $200 million for about a 200,000 barrel a day refinery to operate and make those changes. And so to get those barrels into a refining center, they have to be discounted often to incentivize them to run them. The other option we're looking at currently is exporting it. There's been a couple of exports of the condensate out of the marketplace, and that's even a bigger potential, I guess, possibility going forward. All right, what's happened is as these shale plays are coming to the marketplace, we're having to offset them because refiners, again, we're not structured to run these very, very light sweet crudes. And so we're in the uptick of bringing heavier crudes in. You'll see back in the 1990s, our heavy crudes were 10, 20%, and now we're up to almost 40, 50% of heavy crudes. We're bringing a lot of Canadian. Canada right now is our largest crude source that we're importing. We're importing 2.8 million barrels a day, followed by Saudi Arabia at 1.2. So Saudi Arabia wants to maintain a presence in the U.S. In fact, they're now discounting their crudes in the world marketplace to try to maintain their market share. And then we're followed closely. The other major importers into the U.S. are basically Venezuela, Mexico, Iraq, and Kuwait. So pretty Middle Eastern driven for the most part, other than Venezuela and Mexico. As far as crude oil inputs into our refineries, if you look at what I've been saying, we should be getting lighter, and this should be transpiring. We see this on this very small snapshot. Back in December, the sulfur content at a refinery was running about 1.5%. You fast forward on the API gravity, almost 31 API. Now you come back into May of this year, and the sulfur content was 1.42%. And the API gravity was 31.4. So what that means is that we're running lighter grades of material through our refining centers. And being in the asphalt business, it means there's going to be some impact on our asphalt. All right, this really breaks out, that it kind of graphically just demonstrates what the difference between the crude qualities are. So on these two barrels here, I've got Louisiana Light Sweet versus Maya. Maya is a Mexican crude. On the Louisiana Light Sweet, really what you want to focus is the last two cuts here, the gas oil and the resid. That's the bottom of the barrel cuts. You've got about 20, almost 38%, excuse me, of bottoms coming out of a traditional Louisiana Light Sweet. If you look at what a Maya, which is, and again, this is about a 37 to 40 API gravity crude. Maya is about a 20 to 25 API gravity crude. You get almost 60% bottoms coming out of that, so you get a lot more asphalt yield coming out of a Maya barrel than you do a Louisiana Light Sweet. If you look at Eagle Ford Shale, a very heavy Eagle Ford, a 45 API, you got 21% gas oil and 5% resid. So again, a vast reduction of the bottoms coming out of there. It's an impact for us in the asphalt business. All right, so what are some light crude challenges that we face? Really, we're going to be looking at these in a little bit more detail, but it's the supply chain's changed dramatically. Asphalt yields have come down, and certainly we're looking at exports, and that might change the whole ball of wax. All right, as far as the crude supply chain, traditionally what you went from a wellhead, you went to a gathering station of some sort, into a pipeline, ultimately into a storage facility, and either back out by a pipeline or a large vessel, back into a refining center. With these shale plays, given where they're located at, there's been a tremendous change in the supply chains and the way they operate. And I'll go through some of the dynamics of that. A lot of it's gathered in because these shale plays are smaller in nature and they decline very, very rapidly. They don't really match up very well with pipeline logistics and pipeline economics. So truck and rail is the primary source to kind of get them into the marketplace. All of us that have dealt with trucks in this room know that we've been trucking rates have doubled, in some cases tripled over the last 5 or 10 years. I'll give you, for instance, on rail cars. Rail cars, I leased rail cars back in the economic slowdown of 2008 at between $375 per rail car up to $425. Those same rail cars being leased in 2013 and 2014 were $900 per rail car per month to $1,000. So, rates have gone up almost 2.5 times on rail cars. Another quick fact on rail cars: in the U.S. in 2008. We moved less than 10,000 crude got moved by a rail car. You fast forward to 2013, we moved 450,000 rail cars in the year, and projection for 2014 is over 650,000 rail cars. Put that in today's terms, that's almost 1 million barrels a day of crude getting moved by rail right now. So any of us being involved with moving aggregates or asphalts or any other infrastructure, rail is becoming a constraining component to the marketplace. It's one of the reasons why Warren Buffett bought BNSF out. He thought that the Keystone Pipeline was going to be delayed in getting built, and crude was going to be moved by rail car, and he was going to profit off of that, and he has handsomely. As far as refinery yields of asphalt, historically we've been in the 3% to 3.2% range. We're seeing a drop-off kind of in the mid-2000s to where we are today. We're about 2%. I guess it's kind of good news, bad news. The asphalt marketplace, the demand is about 21 million tons a year. And if you look at the yield of asphalt coming out of refineries, the production capabilities are right around 21. So we're pretty much in balance at 21 million tons a year. To give you perspective, in 2005, it's probably the high of asphalt usage in the U.S. We're about 35 million tons at that point in time, so we've seen a significant drop-off. But refineries, if they're incentivized, they will make asphalt and they will make it available in the marketplace. This is the very first cargo that got loaded out by Enterprise Products. This cargo was a condensate material that was loaded out and went to South Korea to be processed. Right now, there's 2 companies that have the capability of exporting condensates out. They have to go through a processing unit or some sort of a chemical process to get it. They can't just take it straight out of the ground and move it out. They've got to go through a process of some sort. There's 11 other companies that have applied for waivers to move. Europe desperately wants our shale plays. The chemical business in Europe is on its tail. It needs supply coming in. They're running naphthas, which are very expensive. They want the butanes and the ethanes. And so the world really wants to fight over the shale. And so the question is with us in the petroleum marketplace is, are we going to see vast exports of this, or is it going to stay in the United States and have to be discounted? So it's going to impact the production capabilities and ultimately where our prices are going forward. Ultimately, if we're going to find crude, we got to drill for it. And this is what this kind of last slide kind of mentions. That the more we drill, generally the more we find oil. And our technology, if we look at today, really you're looking at technology versus again the OPEX, those with the raw vast resources. And so how the story plays out is going to be interesting over the next, I think, a series of months or maybe in the next year or two. But we certainly have some challenges in front of us. I do believe that we will see, somewhat stable oil prices. Maybe, maybe in that there's been some talk that we could get below in the mid-70s. I don't know if I see much below that at this point in time, but hopefully we're seeing the pump come down. That's good for us as consumers, and hopefully that'll be sustainable for at least a short-term basis here. Any questions? Yes, sir. Yes. How would that lower imported oil? Absolutely would. Basically, the drilling in some of the federal areas, such as in Alaska, would that reduce our dependence on foreign oils? The answer is absolutely yes. We've seen that. We were basically at one point in time almost importing 10 million barrels a day, and that's dropped into about 6 or 7 million barrels a day. What's funny though is we are now, U.S. has turned into an exporting country. We export almost it's about 4.2 million barrels a day of product going outside the United States that gets exported out. Yes.
And one of the reasons, yeah, it's just such a, it's a very margin of safety, but it's drilling so far offshore, drilling so deep, that you know, any little problem will just cause a major problem, you know, major disaster. And, you know, if you're able to open up the federal lands and, you know, be able to drill in on land, which is safer anyway, or drilling close to shore, help out a lot.
Look, I'm not a petroleum engineer. I guess my son-in-law, who is, should probably come and answer that question in more detail. But the answer would be yes. I think most of us realize as you go in the Gulf of Mexico, like you talked about the BP disaster, you know, when you deal under the water in those scenarios, the spill, when oil gets into water, the cleanup and so forth, the dollars per barrel on land, it ends up being somewhere between $10,000 and $100,000 per barrel. In some cases, even more than that for cleanup and remediating the problem. So certainly conventional drilling in Alaska would be much safer than drilling in the Gulf of Mexico if you were to have a spill or an unfortunate accident.